Thank you, everyone, and welcome to Introductions to Financials. Thanks for joining us. As you might know, this is part of our Integral Intro series where we present overviews of areas of expertise that IntegralOrg provides. That ranges from nonprofit governance, legal compliance, risk management, and of course, financials. My name is Liz Tang. I use pronouns she, her, and I'm the program coordinator for IntegralOrg. I'll be around hosting, monitoring the chat, and any tech support you might need. So without further ado, we'll just go into our land acknowledgement. So we acknowledge that what we call Alberta is the traditional and ancestral territory of many peoples, presently subject to Treaties 6, 7, and 8, namely the Blackfoot Confederacy, Kainai, Piikani, and Siksika, the Cree, Dene, Saulteaux, Nakota Sioux, Stoney Nakoda, and the Tsuut'ina Nation, and the Métis people of Alberta. This includes the Métis settlements and the 6 regions of the Métis Nation of Alberta within the historical Northwest Métis homeland. We respect the histories, languages, and cultures of First Nations, Métis, Inuit, and all the First Peoples of Canada who have lived in and cared for these lands for generations. And we're grateful for the traditional knowledge keepers and elders who are still with us today and those who have gone before us. We make this acknowledgement as an act of reconciliation and gratitude to those whose territory we reside and work on today. So I'd very much like to introduce Stella. I'm going to spotlight her for everyone. Stella Penner, she has decades of experience providing financial reporting and governance support to charities and nonprofits. Previously, Stella has held various roles in professional development and as a full-time instructor in financial and management accounting, audit, finance, as well as organizational design and analysis at universities and colleges in Edmonton and Calgary. She also has executive experience as a prior CEO of CGA Alberta.
Well, thank you very much. It's so nice to quote unquote meet all of you. There are a few familiar names in the participant list of people that either are familiar with the organization or you as individuals. So welcome to both those who are familiar to me and those who are new. I'm very happy to be providing this overview. So there's a number of things we're going to talk about, and I want to just stress that the hour we're going to spend together is not going to provide any in-depth answers for any of the questions, but what I'm hoping it will do for you is raise questions in your own mind as you think about the topic in connection with your own organization. Is just think about, is this an area where our organization has got it all together, or is this an area in which our organization maybe needs to do some work and rethink the topic? So it's more of a sorting out of topics that you can use to evaluate your own financial status and situation. So we'll look at what the roles are of the different parties, and keeping in mind that every organization is slightly different in how they define roles, but some of the basics. We'll look at what kind of financial information your board needs in order to do its oversight role. What is internal control all about? And then finally, we're just going to have one short bit at the end is what is the connection between budgeting and internal controls? So starting off with who's who, before we talk about financial matters and where an organization's financial disciplines are, let's look at who's responsible, who the different players are. So the board of an organization, of a not-for-profit, has oversight responsibilities. So generally they're volunteers. They're doing this in addition to their regular jobs, their regular lives, as a way of giving back to the community. And so they only have a limited amount of time available, so they focus on oversight rather than doing. And so that's the typical role of the board, is oversight, planning ahead, stewardship, because you're using other people's money. So the board will be thinking about how are we protecting the resources provided by donors and contributors. And then they have also fiduciary duty to assess risk and to protect the organization from unreasonable risk. So they're the big picture group. They have the legal and fiduciary responsibility. Within that group of volunteers, either as a board member or a separate volunteer, you'll have a treasurer. And in the bylaws of most organizations, there'll be a little bit of a job description of what the responsibility of the treasurer is. And I like to think of the treasurer as a bit of the liaison between management and the board. So they're kind of like doing the eyes and ears of the board when it comes to financial matters. And so they'll provide advice to the board on financial matters and may provide advice to management on financial matters. So to provide that bridge. And so the treasurer, ideally, you would want to have them be somebody who has some accounting or business knowledge, knows how to read financial statements, and so on and so forth. And then the last person that has an active role in the accounting side of financials, the reporting side of financials, is the bookkeeper or accountant. Now, you know, I notice I'm leaving the executive director out of here. It's not because they don't have a role in the organization's finances, but I want to look at the roles and responsibilities sort of in a more hands-on way. And so the accountant is not the treasurer, and the treasurer is not the accountant. There are organizations in which the treasurer are so small that the treasurer actually does the bookkeeping, but that's not sort of the default role. The bookkeeper or accountant would report to management. They are not, the board is not the boss of the bookkeeper. It's the executive director who's the boss of the bookkeeper. And so they would be responsible for entering the data, preparing the preliminary reports, and very often they would also have a role when it comes time for the audit, but the bookkeeper would be the person answering the questions for the auditors, providing the data and the accounting records to the auditors. So each of these parties has a role. And what is confusing for organizations sometimes is when they're very small is there's overlap between the roles, the volunteer and the staff roles. But I think one of the key things, and the question that you want to ask yourself about your organization is, are there job descriptions understood for each of these roles? Hopefully in writing, but not in writing, at least in practice, that everybody knows what their job is and not stepping on each other's toes. So when we're talking about the bookkeeper providing financial information to the treasurer, and then the treasurer reporting to the board, what kind of financial information does the board need? Let's just look at a few pieces of financial information that the board needs to say, where are we going? Where are we now? And then how are we able to plan and monitor our decisions from a financial perspective? So what kind of information tells us where we are now? So the statement of operations tells us, you may call it an income statement. It's a statement that says how much money have we taken in or earned in the period versus how much have we spent. Is there a difference there? Another thing that tells us where we are now is comparing that income statement to what we'd expected, what we planned for or budgeted. The statement of financial position, I just want to stop briefly and emphasize that. That's a statement that a lot of boards don't look at very closely, but I think it's important to look at the balance sheet or statement of financial position, because it will tell us what are the resources we have available today and what are the commitments against it. So here's the cash on hand versus the accounts payable. You know, we may say, oh, wow, we've got like $1 million in the bank. But if you've got $1,001,000 worth of payables, then having that big chunk of change in the bank isn't that useful. So your financial position will offset your assets against your liabilities, your resources against your obligations. And then the last thing that I think it's important to know, if you receive restricted contributions, such as grants that have to be spent for very specific things, is to understand how much of your resources are committed to specific programs and activities. So how much of the cash you have is restricted for specific things, of the contributions received, how much of it is actually supposed to be deferred into the next period, as opposed to being able to be spent in the current period. So those are the pieces of information that tells us where we are now. The financial information that you provide to the board, or that the board gets, that talks about where are we going. A lot of this, the board is responsible for having input into it. For example, the strategic plan and priorities will normally have a financial implication. So what programs are we going to prioritize? What target groups, what client bases are we going to prioritize? That would be part of our strategic plan. And then how are we going to allocate resources to those priorities? So when an organization does a strategic plan, I've seen them from time to time completely ignore the financial aspects of it. They'll say, oh, wow, we're going to, not just make Alberta a better place, we're going to make the whole world a better place. Well, that's great, but how are you going to finance that? Where are the resources going to come to allow you to expand your borders beyond Alberta or beyond Calgary or whatever your area of influence is? Capital life cycle plan. If you're heavily invested in capital assets, if you own a building or multiple buildings, it's important to look ahead to when are those going to need to be replenished or replaced. And then sort of more midterm projections are also important for planning ahead and seeing where we're going. And of course, the current year budget, which is based on a more immediate action plan. Those are the financial pieces of information to help us see where we're going. And then on a more mundane level, the board will need financial information that will help them to understand where they are today in relation to their budget. Have we received more money than we had expected? Have we received less? Have we spent more or less? And more importantly, then, why are those numbers different? And what are we going to do about it? And so that's where the role of management and the bookkeeper falls. Is, okay, we expected to get in, $100,000 for this particular project. That's great. We were going to spend $100,000 providing the services for that program or project, but we've already spent $102,000. Well, what are we going to do about it? Where are we going to make that $2,000 back? Are we going to be able to cut expenses somewhere else? Or has the funder maybe agreed to an inflationary increase? So that's how the shortfall is going to be made up. So why are there variances between plans and actual? And more importantly, what are we going to do about it? So that when management goes to the board and says, here's our budget to actual comparison, they can immediately tell the rest of the story. And here is what we're going to do about it. So that is often done on an exception basis, so that management will be giving guidelines. If you're within 2%, within 3%, within 10% of a particular line item, don't bother mentioning it. We want to know on an exception basis the explanations for variances. We don't want to know every little paperclip that you've overspent on, but we want to know where the big stuff is. We've had to give all the staff a raise for some reason because of, their peers and other organizations are getting, and if we're going to keep them, we're going to have to give them a raise. This is an exception to our normal planning, and the board needs to be informed and know that management has a plan to resolve it. So those are sort of the broad areas of financial information that a board needs. Is where are we now, where are we going, and monitoring those plans of where are we going from a financial point of view. So the other area that I'm going to suggest that you consider, and I'm going to spend a little bit more time on financial controls. I'm an accountant, so you're probably not surprised, is to help you sort of assess, are our controls strong in this area, weak in this area? We don't know how to assess them, but to zero in on specific areas of financial controls. And so many of you have been through audits with your auditors, or you may be auditors. And so you know that the auditors like to talk about internal controls. But I want to stress that internal controls are not there for the benefit of the auditor. The existence of financial controls, the first and most important purpose in controls is to make sure that management policies are implemented. And so a control may be, an internal control may be, maybe let's say you have a little restaurant. And one of your policies as management is that the bathrooms have to be cleaned every hour. So what do you have as an internal control to make sure that happens? Well, in a lot of restaurants, you'll see some sort of a checklist on the inside of the bathroom door where when the cleaning check happens, is the person who's doing it has to initial or sign off or something. And so the control is that sign-off sheet or that initial sheet saying, yep, I checked it every hour. The policy is the frequency of cleaning. And so that checklist is there to ensure that management's policies are followed. It doesn't serve any purpose on its own. And in the same way, controls over, say, who has to approve expenses. So there may be a management policy that says that expenditures of over $5,000 must be approved by 2 people. Well, how do we make sure that happens? Well, you have some sort of a check and balance that checks over 5,000 have to be signed by 2 people. And so the purpose of it is to make sure that management's policies are followed. Other controls have a goal of protecting the assets. And again, everything around, cash, how is cash handled, how are checks distributed and issued. A lot of those are around protecting your assets. Having insurance, a policy that you have insurance is an asset protection policy. Requiring that passwords are required to enter a building is an asset protection policy. Other policies are around reducing risk. So you're never going to have risk be at 0, but you want to have policies in place that will reduce risk to a manageable level. Some internal controls are simply for efficiency. So things that can be done sort of mechanically by having a system, a constant system, that everything always gets done the same way might make it more efficient. So just something like we only do check runs twice a month is more efficient than issuing a check every single time somebody comes in, with an invoice. And so there may be controls that are created primarily for efficiency purposes. So let's look at what kind of policies you might have in place. And again, as we're going through them, think about whether you think it's asset protection policy, an efficiency policy, or something specific like that, what the purpose is. So financial controls fall into 2 broad areas. The first we're going to look at are general or entity-wide controls. And so they are not affected by the level of detail of anything specific. If they're working, they cover everything in the organization. So entity-wide controls. And if you're having trouble picturing that, I'll talk about a few examples in a minute. And then there's other controls that are very specific. So controls around how the bank account is handled are very different from controls about how the washrooms are cleaned. Controls about how HR works, how people are hired, is very different than controls around how inventory is managed. So they're very specific. And controls can be one of 3 directionals, if you might say. So they may be preventive controls. So they may be a control that prevents something from happening. So you can't access the bank account unless you have authorization and have the right password. That's preventive in nature. Or they may be detective in nature. It may be the accounting system may produce a report of everybody that's gone in and accessed the system. So that's detective in nature. We see after the fact who's accessed the system, not so much that we prevented you from getting in and looking something up, but after the fact we know that you have. And then separation of duties are generally, from an accounting point of view, we think of separation as duties as separating the documentation or recording of an event from the custody of the event. So the person who collects the cash is not the person who records the cash in the customer's account. So if you get to take the money in, let's say you have cash sales or cash donations, and you're collecting the money, and then you're also writing in the general ledger how much we collected, and making up the deposit to take to the bank, that really increases the risk. So we like to have one person who gets the money in the door, someone else who counts it, and then a third person who records it, so that there's a check and balance, because there's multiple people that are involved in that process. So those are kind of, and if you have whether you use a preventive control or a detective control, to a great extent will be dependent on how much the risk around that particular type of transaction is. So let's look at some examples of general or entity-wide controls. The first one is hiring the right people and knowing the right people. So there's a great deal to be said about hiring people who have management experience for management roles, who have programming experience for program roles, who can then work their way up into management of programs. If your organization provides transportation, maybe school bus services, or taking kids around, you want to make sure that you check references, that you check a person's driving records. And so having policies around who you hire, checking references and things like that is an entity-wide control. You check references no matter whether you're hiring a bus driver, a secretary, or a manager. And so knowing your people. Another important, really, really important entity-wide control is what we call culture or tone at the top. So how seriously do managers take the rules or the policies? So if you've got a senior manager or a board member who says, oh, don't worry about that policy, we'll make an exception this time, and that happens repeatedly, that sends a message to people lower down the chain that the controls and the processes are not important. So by having a culture at the top is, this is our policy, and even if it's inconvenient for me, we're going to follow it. So it sends the right message to everybody throughout the organization that controls are important. Another control that we generally consider entity-wide is how carefully do we keep confidential and private information? Do we have password requirements? As an auditor, if I walk around somebody's office and I see on everybody's monitor there's a little yellow sticky with their passwords, then I'm going, access to information is probably not taken that seriously here. And then the last one is, does your organization have a value statement? That may be called a code of conduct, a code of ethics, value statements, but do we all adhere to and ascribe to, we do things honestly and transparently and treat people fairly? Just putting that in writing has a huge impact on people in the organization. So those are sort of our entity-wide controls. Who are we as an organization? Will go a long way to making sure that things as they trickle down correctly. The kind of internal controls that most of us are more familiar with are very specific ones. So we're going to just look at sort of half dozen examples. These are just examples of typical internal controls that are very specific to things within the organization. So, and they're all in the financial area. So the first thing, this is the one that I would expect every organization, no matter how big or small, to have policies around the bank reconciliation. So by having a a clear-cut policy that the bank reconciliation needs to be done every whatever period it is. I would suggest minimum would be monthly. I've worked in organizations where we did the bank rec weekly, and frankly, it's way easier to do it that often. But I know not all of you will agree with me, but that's been my experience. But the bank rec is key because all of the financial transactions in the organization at some point go through the bank. So even if it's you've got an expense that you haven't yet paid, eventually you will. If you've got money that you're expecting from the government but haven't yet received, eventually that money will make its way through the bank. So that is kind of the key point at which you can check and test, is when the money comes out of the bank or goes into the bank. If there was a mistake in setting up a receivable or a payable, the point at which the transaction goes through the bank gives you a chance to test it again. And it's just a great way of ensuring that the accounting records are accurate. If the bank rec is right and consistently right, then I've got a lot of confidence in the rest of the accounting records as well. The other thing that's really important, I think, is that the bank reconciliation be reviewed by someone other than that does it. So if you've got an accountant or bookkeeper who's doing the bank rec, then I would recommend that their supervisor or the treasurer or someone reviews it every periodically, probably as soon as it's done, or maybe quarterly, do 3 at a time. But by having the bank rec reviewed by a second person, again, it gives the person who's preparing it knows that someone else is looking over their shoulder. And I think it's critical that you have the bank rec reviewed and that it be documented. So the person either initials it or sends an email saying, I've checked it, thank you very much, everything looks fine. Another specific financial control that I recommend is having clear policies as to who can approve expenses. And normally, if a person is preparing the budget for their particular program area, you would expect that they would then also have the authority to spend the money. Once the budget has been approved, it shouldn't take a second coup to then be able to spend the approved budget. So normally I would say whoever's responsible for that budget line item should be able to approve the purchases. And I would suggest that that person should also be coding them as to which account they go into. So when I prepare the budget for my program area, I'm planning to spend so much on maybe food supplies, maybe I'm running a kitchen or a lunch program or something. I'm going to spend so much on food. I'm going to spend so much on casual help with, the cleaning, serving. These are the different things that I'm going to spend money on. So when I'm approving the invoice, I know which budget line that expense is supposed to come out of, because I know where I budgeted it. So I would say approval and coding should go together hand in hand. And the other thing that we often misunderstand is that approval of the purchase and approval of paying for it are not the same thing. So as a program manager, I know that I have an approved budget. This particular expense falls within that, but I don't know what the organization's cash flow policy situation is. So it should be somebody sort of higher up the chain that says, yes, this is a valid expense. Joe program manager said this is a valid expense for what he's operating, but we're not paying it until the end of the month. And I'll let you know when it's okay to release that check. So payment and purchase approval in most organizations are two separate things. Another specific area of controls is around deposits and revenue. So one of the things we're looking at is nowadays so much money comes in digitally. So if you've got grant money coming in, it's usually done by EFT, electronic funds transfer. If you've got small donations coming in, you may be using a credit card processing system to accept cash donations. So in many cases, there's less and less transactions coming through by check and certainly by cash. But if you are still receiving cash and checks for whether it's contributions, donations, or sale of goods, if you're selling goods, is have a policy on how often those deposits need to be taken to the bank. You don't want a lot of cash piling up in somebody's desk drawer or even in a safe. So have a policy every Friday, or when the total goes over 5,000, or whatever your policy is, to make sure that that gets deposited on a regular basis. Another policy, and I'm going to just take a little bit longer on this one, is a lot of organizations found with the pandemic that people were sending the money by email transfers. So you go into your bank account, and you pick a recipient, and you send money. And it was kind of designed for person-to-person transfers that banks set it up. But with the move to not doing things in person, a lot of our clients we found were getting donations by email transfer. And I want to be clear, I'm not talking about EFT, electronic funds transfer, that's business to business. I'm talking about somebody just emailing. So I, go into my bank account, I say, I'm going to send Liz $20. I find her email address, set her up as a payee, and send her money. And she gets an email saying, Stella, I sent you $20. Where do you want to put it? And so she'll pick her personal savings account. She said, well, I'm just going to tuck it here. Well, when organizations get money by that method, the person who's receiving that email can decide where they're going to put it. And so especially when this first started happening, we did see there was a surprising number, and you may think auditors are finding fraud all the time. That's not so. Auditors don't find fraud a lot. Like in all the years that I did audits in not-for-profits, I would say we encountered fraud maybe once every second or third year at most in one client or another. Not always the same client, obviously. But when this email transfer business started happening, we started seeing little ones. So people would be taking like $20 or $50, money that was supposed to go for a ticket sale would end up in someone's personal bank account. So there's ways to improve the security around email transfers. I would still recommend that you find alternative methods for donation receipts. But if you are going to accept them, then make sure that the donees know, or the payers know, that they go to a specific email address, which is not a person's email address. So they should not go to stella@charity.ca. They should go to accounting@charity.ca or donations@charity.ca. So you want to make sure there's a dedicated email address primarily for receipt of email transfers, which again, I don't encourage you to get, but if you do, and then work with your bank to set it up so that transfers to that email address are automatically deposited. So the person receiving it doesn't get to pick where they put it, because they could choose and log into their own personal bank and put it there if you don't have this automatic. And make sure that any staff that might be receiving emails from people that have money attached, that they make it clear, if it comes to you personally, to your like your stella@charity.ca, I have to refuse to accept it. I contact the person and say, no, please use the donation email address. And then that dedicated email address should be accessible by at least 2 people, so that it isn't just one person that's watching it. And so the responsibility for following up on that should flip back and forth between the people. So maybe normally the bookkeeper is making sure that those deposits went into the bank, but from time to time, someone else should have the responsibility of reading those to the bank statement, so that it isn't always the same person. And those are just a few ideas of how to deal with e-transfers. Again, discourage them at all costs. I've seen so many cases. I'm treasurer of my particular church. And when this first started happening on a regular basis, people would be using to send emails. They would be sending email addresses like, you know, good looking dude or something at hotmail.com. I'm just making that up. Well, I'm going, we've got so many good looking dudes in our church. Who could this be? So we didn't even know who the money was coming from in a few cases. And so tracking that down was quite a challenge. Hiring and payroll, you'll want to make sure, and again, as an auditor, I was shocked how many of our clients did not have written policies in place as to how they hire people, how they notify payroll when there's changes in salaries. You would say, okay, this person is getting, you know, $2,000 for the month of May. Who approved the $2,000? We look at their payroll file and they were hired for $1,500 a month 4 years ago. Well, at what point did they get a raise and who approved it? So just some basic controls around making sure that hiring, including the terms of employment, are well documented. Not just a personnel file with evaluations, but also a payroll file that has their financial approvals. This person was hired, this is what their vacation entitlement is, this is what their salary is. And then when they get raises, who's authorized that, put all of that in writing. And it's very helpful if you use an external payroll service that provides a bit of separation of duties so that you have someone who is professional and skilled providing reports to you. So whether it's Ceridian, Payworks, ADP, I don't have any strong feelings about one or the other, but I do think provides a really good opportunity for internal control is using those outside services. I think it reduces the risk of error, of human error, to a great extent.
Stella, I just had a relevant question. One question was, in speaking about payments, are there any concerns with making payments via e-transfer? I know we're touching on that.
Yeah, I would recommend. I mean, you can't sort of control what donors do, so receiving it is very hard to eliminate altogether. But I would never. I just can't think of a situation in which an organization, a nonprofit, would give someone the authority to send payments by e-transfer, email transfer. The banks have corporate accounts that will allow for EFTs, so electronic fund transfers, and so those are processed more like checks. So you have your invoices that you're paying, you have your EFT information that you need from your vendors, and so the person who would normally cut the check, if you were issuing checks, goes into the bank and prepares the pay run, if you will, the payment run instead of a check run. And then someone with authority will log into the bank and release them, which is then the equivalent of signing the check. So a different person would prepare the payment batch, I guess you call it, and then an authorized person would go in and release it. So you've got two people. The alternative, if you want the person who's preparing the EFT batch to also be the one who has the authority to release it, then you would want some sort of documented step in between. So in the case of my company, my controller would prepare the planned payment batch. She would give it to me in digital format, but outside of the bank. And I would add an electronic signature to approve the release, and then she would go in and release it. And, you know, it would have been better if I had gone in and released it. But as a firm, we decided that if I was documenting the approval, because I would then review the bank rec later, and I would make sure that all of those distributions agreed to what I had approved. So, yeah. Does that answer the question?
I think so. Yeah. Yeah. Thank you for letting me interrupt you. And then I think the other. Sorry, go ahead.
It's very rare. I just recently ran across an organization where they send out email transfers to some of their subcontractors, which surprised me because I've not run into it as a vendor myself. I do work for not-for-profits, and I've never encountered that before. I usually have to send a void check, and they do it through the EFT process. If you're with RBC, it's called RBC Express. So each bank has a different name of what they call that program. So the last area of sort of bucket or area of financial controls that I want to talk about is around regulatory compliance. And so that usually falls under the financial umbrella in most organizations, particularly small organizations. So if you have a controller or director of operations or a treasurer, they're often responsible for making sure that these are met. So when I say regulatory compliance, the first one is the program report. So these may be financial or results oriented or both. So if you're getting money from a government agency to deliver a certain program, at some point you're going to have to report back on what you did with the money. And that might be a report saying that we served so many school lunches in the last 6 months or the last 12 months, if that's what the program funding is for, or if it's a daycare program, this is how many children we had in the daycare each month. And so that's the results reports, but there's often also a financial report required. And so who is responsible for making sure that those get out? Somebody needs a list that in 90 days after year end, we have to get a report to FCSS. By June 30th, we have to have a report to, the province or whatever. And so who is responsible? Have it very clear whose responsibility that is and where they're going to get the information from. Tax filing. So if you're a charity and you have to file a T3010, you might get a GST rebate that you're eligible for. Who is going to be responsible for making sure that those get done? And if you're hiring your outside accounting firm to actually prepare them, you still need someone in the organization that's going to be sort of seeing that that gets done, answering the questions, following up to make sure that it was signed by the appropriate people and submitted to the tax department on time. And then the other one that often gets overlooked is the documents that are needed to keep our organization in existence. So for example, if you're incorporated under the Societies Act, there's an annual report you have to file with Alberta corporate registries that will list who your current list of directors are, provide a copy of your financial statements to corporate registries. And so who is going to look after that? And some of these are a bit wonky. So the annual society's return, for example, is not due at a particular date after your year end. It's due 6 months after your anniversary of your incorporation. So maybe you got incorporated in April, their year end is December. So you have to file your annual society's return 6 months after April, so sometime in October. And so it's not even necessarily the exact last day of the month. So somebody needs to keep track of that and then what information goes in with it, who is going to gather that and see that it gets in. Because a failure to file those annual returns can mean that you might no longer exist. And that would be very challenging to get yourself recreated if you let your existence as a society lapse, then your charity status also lapses. And to get all of that reinstated is very complex. So just figure out who's going to look after this and make sure that they look after it. And then the last piece of controls I want to talk about just very briefly, that budgeting is a form of internal control. So that's why I put this slide here. What I find very different from one organization to the next is what is the significance in the role of budgeting within the organization. So in my view, budgeting is planning. And it includes obviously financial planning, but it should start with activity planning. So what activities are we going to do, and then how much it's going to cost us to do that, and where are we going to get the money from? So what activities, and it starts with what are our priorities and goes from that, works from there. However, in some organizations, once the board or the finance committee or whoever has the authority to approve the budget, that then approves the person to spend the money. Other organizations, approval of the budget does not imply approval for expenditures. So you need to know what the policy is in your organization. When the budget is approved, what does that mean? What does that then delegate other authority? And it forms a basis for monitoring on an ongoing basis. So if you're a really tiny startup organization, you may not need to budget initially because you don't have too much of an idea of where things are going. But very quickly in the life of a nonprofit organization, you're going to reach the point at which budgets become sort of a critical foundation or basis for effective financial controls. And it's not a bad idea to start practicing before they become critical, and just say, well, we're just going to do a little mini budget because we need to get used to the process. And so that's sort of the role of budgeting. I not to toot our own horn, but IntegralOrg does have seminar. It's I think a 90-minute seminar on budgeting. So if you're getting to that stage of we think we're going to start developing a budget and we haven't before, or we're not using it very effectively, you may want to consider that. So just to recap, do you know what your role is within the organization? Do you think your board is getting the financial information they need? If not, where are the missing pieces? Do you have some basic financial policies in place, both entity-wide and specific transaction type of controls? And then finally, are you using budgets effectively? Those are the kind of things that I'm hoping you'll think about as you leave the seminar today. I'm going to let Liz take over from here and just explain a little bit more about IntegralOrg's role in answering the questions that I just raised, and then we'll take questions if there's time.
Sometimes there are just questions that arise that need a little bit more in-depth information about your organization before Stella or anyone can offer a fulsome answer. So in those cases, we might refer you to check out one of our free consultation services, which can either look like a short virtual or phone conversation between one of our IntegralOrg experts and whoever your team is, or a 1-hour problem-solving session. So IntegralOrg itself is a nonprofit and with experts like Stella that are super well versed in the nonprofit world, but sometimes we just need more information, and that's when I would point you towards that. So this question is, if your provincial filing is due 6 months from date of incorporation and that date is prior to you completing your audited year end, what action is required? Do we send a letter stating the audited financials will be completed and sent in 2 months, or do you send last year's audited financials?
I'm so glad you asked an easy question. So I'm assuming that you're incorporated under the Alberta Corporate Nonprofit Alberta Societies Act. So the wording in the Societies Act annual return is that you're supposed to send in the financial statements that were presented at your last annual general meeting. So in some cases, that means you're always providing financial statements that are almost like 1.5 years old. So the literal wording is the financial statements that were presented at your last annual general meeting. So you can figure out where that fits. If you're, let's say you're incorporated in April, your return is due in October, but you're not having your AGM until December because your bylaws allow for a very long stretch, then you would do the prior years. If you have an AGM between April and October, then whichever financial statements are presented there. There is some more comments about questions in the chat about the e-transfers. And I realized that it is very difficult once you've started that process. And like I said, it really accelerated when COVID started, because organizations that might normally have had people dropping in and so on, you know, particularly it was a real issue in person kind of programming. So you might have taken people's payment at the door when they were coming to an event, and now the event is virtual. So how do you take their money? And so it is quite right, and you can't prevent it entirely. But I do think that we can make a choice not to use that ourselves, to send money out, because I think you know, all of our banks have mechanisms to send money out more securely, and we're all used to vendors asking for our banking number so that we can exchange money electronically, and so I think we want to build controls to minimize the amount of email transfers that come in. That would be my advice. It's a risk mitigation thing. It's one of those things where if you can't eliminate risk altogether, at least try and get it to as little as you can.
So my question is, have you encouraged organizations to have kind of decide what that next strategic growth priorities are just leading up to the budgeting, and knowing that a lot of, you know, I've heard recently, like if someone doesn't have a strategic plan, they should be able to look at a budget and almost give you a summary, because we're tied in some ways to that next kind of fiscal. And we're just trying to encourage staff to like, okay, now here's your season or here's your quarter, bring forward the ideas, let's get it out. And then let's also agree to hunker down and carry out that plan, whatever we decided, versus that constantly moving priority piece. What's your thinking about that?
I think that's can be quite different from one organization to the next. So if you're thinking of an organization that's in a strong growth phase or startup phase, it's almost impossible to do a meaningful 3 to 5 year plan, because things are going to change. They're changing tomorrow. They're changing the day after. So from a financial point of view, I would recommend that you still try and do a 2 to 3 year rough projection, and kind of decide as a management team or as a board at what point you're going to revisit that. Like if this doesn't work out, then we're going to retrench, or if we see a new opportunity, here are the steps we're going to do to vet that opportunity, and have some sort of a benchmark for what are our criteria before grabbing the next opportunity. And it's kind of hard sometimes to say no when we have an opportunity, but if you have your priorities, maybe the priority is financial stability. Is this going to contribute to the financial stability or not? Is this going to make things more tenuous or more secure? So I guess having some benchmarks against which you measure opportunities.
This one is, this person recently had a situation where the bookkeeper was not paying or filing payroll tax returns. What controls could have been present when she was assuring me that everything was handled when in fact it had not been?
Well, there's a couple of different ways. Firstly, if you're using an external payroll service, that wouldn't have happened. So that's a big one. But if it's too small, maybe only 2 or 3 employees, and you don't feel it's worth the money. The other thing is having someone review the when you're doing the bank rec, whoever is reviewing the bank reconciliation. So if you have a policy where a treasurer or someone on the board is reviewing the bank reconciliation, then just look through the clear checks and see if there's a check there going to CRA. And And we have 3 employees, but we have 4 paychecks. What's wrong here? It's just sort of some basic common sense reviewing items on the bank rec might have revealed it if the person knew that that's something they were looking for. And then the other thing is having access to your CRA account, your online account. So I would suggest that both someone like within like the bookkeeper, maybe if you're not big enough to have a controller, maybe then the bookkeeper, the executive director, and the treasurer should have access to the CRA account. You'll be able to see that. So the last question I would like to answer is the question about the internal controls versus and the board of directors reference manual. And so I did not distinguish in my talk between the difference between management policies and board policies. So generally the board would have governance policies that direct management as to where, to provide guidance. And this is what we're going to be measuring you against. And so they might, for example, a board might have a governance policy that says the executive director must have a balanced budget, just for example, or the executive director must have a written HR policy. And so those would be kind of guidance for the management as to where you need policies. The examples of the policies I was giving you were mostly management policies. And so they wouldn't necessarily be specifically in the board of directors governance policy manual, but they would be referred to as being a minimum threshold for policies that we expect management to have in place. And that is something I can talk about for hours. So if you want to book a consultation, I would be happy to chat on that further.
If anyone is interested in furthering any of their financial management processes, we do have 2 webinars coming up, also facilitated by Stella here. The first one focuses on GST obligations and entitlements for both nonprofits and charities. That one's in late September. And then the second one touches just on the best practices of budgeting. Last time we had some really great Q&A portions for these trainings, and so we have extended the training to include some more time for that. And they're both great opportunities to gain some practical knowledge. And you do have a discount code, which when you visit the page, you'll be able to see it. It's $10 off of the $30 ticket when you bring someone else to attend with you. Thank you, everyone.
Thanks again, everybody.